What we see when we look at Japan is the future of the U.S., and it's potentially not pretty. I mean, it could be just this brutal financial reckoning that nobody is prepared for right now. It could just be that gold is telling us that the higher Japanese interest rates go, the closer we get to some kind of a financial cliff. And you want to be in real money when that happens, not a fiat currency that has to be inflated away in response to some kind of a crisis. We're getting close to the point of some kind of a squeeze in this market where, somebody takes a huge amount off the market. That causes some turmoil at the exchanges. That causes everybody else who's in the same boat as that first big buyer to panic buy. And then silver goes to who knows where, as the saying that's going around now goes, it becomes unobtainium, you can't get it at any price.
You're watching CapitalCosm. My name is Danny. It is December 4th, 2025, and my guest today is John Rubino from rubino.substack.com. Be sure to check out his Substack, guys. John, thank you so much for coming on, my friend.
Hey, Danny, thanks for having me back.
Yeah, always a pleasure. Let's go ahead and dive right in here. John, I know you're looking at the Japanese 10-year. You and I were just talking about it. So let's just kick it off with that. I mean, this thing is blowing sky high. What's going on with the debt markets in Japan, John? And what does this portend to the rest of the world? I mean, obviously, this has ramifications worldwide. You look at the 10-year yield on the Japanese debt market, currently at 1.94 at the time of this recording. Japanese 30-year also at 3.39 at the time of this recording as well. Both are rocketing higher. What does this mean for the average investor? And what does this mean for the world?
Well, to understand the significance of Japanese interest rates, you have to understand the yen carry trade. Mm-hmm. And basically, for the past lot of years, Japan has had artificially low interest rates because their government has been borrowing just crazy amounts of money. And their government for the longest time has had more debt on a per capita basis for the population than any other country in human history. It's a really dangerous looking amount of debt. And as part of the process of dealing with that, they've kept their interest rates extremely low. So it's created this thing called a carry trade where you could borrow yen at extremely low interest rates. Then you take those yen and you convert them into Brazilian currency or US currency, buy treasury bonds, let's say, with it. So you borrow at 1% in Japan, you invest that money at 3% in the US, and you have this spread that you carry going forward. And you make money thanks to the beauty of leverage. You make crazy amounts of money by just carrying those two transactions going forward. And this works as long as the yen doesn't go way up against the dollar, let's say, because then you have to cash your dollars out at some point and buy yen. But if the yen are appreciated, you lose big. And also, if interest rates in Japan don't go up to some unsustainable level, like if you have to roll over your Japanese loans, your yen loans, but you have to pay way more for it, then the carry trade breaks too. Now, the reason why the carry trade breaking is a big deal is because there's literally trillions of dollars bet on the yen-dollar relationship and Japanese interest rates versus U.S. interest rates being pretty stable in a profitable way for the yen carry trade. When Japanese interest rates go up beyond a certain point, that carry trade stops working. So it's not really profitable to do it anymore. And that means all kinds of deals have to be unwound out there in the world, some of them very unprofitably. So there are a lot of basically landmines out there now, things that are getting ready to blow up. Nobody really knows where they are, what's going to blow up first, or what the knock-on effects of them blowing up will be. But it's potentially a big deal for the global financial system. Now, meanwhile, for Japan itself, its interest rates are going up dramatically, in large part because nobody wants to lend money to a country that's that indebted. And that means the average interest rate, the average interest cost on Japan's debt is going up commensurately. So let's say you've got debt of 250% of GDP and your average interest rate goes from 0 up to 2%. Well, now you're paying 5% of GDP on interest. which is more than the defense budget, no doubt, and more than a lot of big social programs in a country. And that means that money that you have to pay in interest has to be borrowed because you're running a deficit already. So your deficits start to go up exponentially. And there doesn't seem to be any kind of a fix for anything like that. So that's where Japan is now. Now, the US is heading for that way or for that place at an accelerating rate too. So what we see when we look at Japan is the future of the US. And it's potentially not pretty. I mean, it could be just this brutal financial reckoning that nobody is prepared for right now.
Now, you recall last year in August, we had an episode of the yen carry trade unwinding, but it seems to have been fairly tame the last year or so. Why is that the case, and what's keeping things from going off the rails, even though we've seen interest rates rise for quite a while now as it relates to Japan?
Yeah, interest rates can rise for a while without blowing up the carry trade, but there's a point at which it doesn't work anymore. And so we don't know what that number is. Let's say on the 10% or the 10-year Japanese Treasury bond. Now it's pretty close to 2% right now, the yield, and that's much higher compared to when it used to be negative. You know, the Japanese government used to be able to borrow money 10 years and make money on the deal. Well, now they're paying a huge amount out. They're losing money on the deal, and the higher the interest rate goes, the closer we get to the point where the whole edifice breaks, and we don't know what that number is going to be. So, across the global financial system, it's kind of a search for the number now, where mistakes are building up and they're building up, and then there's some number related to those mistakes that makes it all stop, and we don't know what that's going to be. But the math says that Japan is getting close. And obviously it's not there yet because things aren't blowing up right and left everywhere out there in the global financial system, as well as in Japan. But we're at the point where interest rates going up much from here are extremely dangerous, and yet they're still going up. You know, the rate on the 30-year Japanese bonds is just skyrocketing right now. It's up to levels that are pretty much at US levels, which is the first time in our lifetime that that's been the case. So it's not blowing up yet, but it could at any time. And the higher rates go, the closer we get to that decision point.
Yeah, I'm going to overlay an interesting chart here in a second. That I was just done. I just got done interviewing Bob Moriarty yesterday, or the day before yesterday, and we looked at an overlay chart of this and gold, and there's some interesting correlations to that. But before that, I just want to remind everyone to hit that like and subscribe if you are getting value from this video and the other videos that we do here. It really does help us in the algorithm. So hit that like and subscribe, guys. Comment down below if you are getting value. And here we go, John. Look at that. Look at that correlation here. I'm going to make this a line graph, and yellow is Japanese 30-year yield. Blue is the gold price. And they've pretty much been moving in tandem now since 2011 or so. You look before 2011, it appears that they were inversely correlated, let's say. But since 2011, since that peak in gold, they've been moving pretty much in tandem. You did have a little bit of a delta here between the two from 2018 up until 2022. And here's that magic year when everything kind of broke. 2022 is when interest rates started to break out. 2022 is when you started to see gold start to really move on to the upside, as you saw here with this blue line. And since 2022, the two have been inseparable. The interest rate, the Japanese interest rate, as well as the gold price. I mean, what's your best guess in terms of what's going on here, John?
Well, I wouldn't want to commit to any kind of analytical conclusion, but that is an ominous chart. I mean, anything that gold follows upward is usually a bad thing, because gold is a barometer of stress in the global financial system. So it could be something as simple as Japanese interest rates going up, people watching that, getting more and more worried about what it does to the yen carry trade and to the Japanese economy directly, and buying gold in response. Gold is where you hide out from things that are unpredictable and disturbing. And spiking Japanese interest rates are the definition of unpredictable and disturbing. So, yeah, it could just be that gold is telling us that the higher Japanese interest rates go, the closer we get to some kind of a financial cliff. And you want to be in real money when that happens, not a fiat currency that has to be inflated away in response to some kind of a crisis. So, I mean, your and my investment thesis from all of this has always been that you want to be in precious metals and other kinds of hard assets. And this chart just shows that a lot of people have made the same decision.
Yeah, because you've got to remember the interest rate chart is essentially an inverse of the bond value itself. So the lower the bond value goes, the higher the interest rate goes, and vice versa. So when we're looking at this chart, we're really tracking the gold price moving in conjunction with the diminishing of Japanese debt. And of course, you could actually look at this from the TNX, from the U.S. 10-year yield. It's not as profound as the Japanese 10-year yield, but there's a bit of a pattern here. The gold did move in tandem with the U.S. 10-year, but the 10-year yield on the U.S. side has been moving sideways for a while now. But let's go ahead and take that off. And let's look at gold in isolation here. It looks like the precious metals are getting ready to heat back up again. And what's odd is that it's in December. December is usually a very seasonally, slow news month for the precious metals. Here's gold. It looks like we're consolidating here right now. Silver's moving up. But what do you make of this recent move in gold? Is this a consolidation pattern we're seeing here?
Well, gold had a hell of a run. And you would expect actually a much bigger correction than we got, because it blew through $3,000 an ounce and then through $4,000 an ounce, which created a lot of profits for people to protect. So it wouldn't be a surprise with a chart like that for a lot of people to take profits up above $4,000 an ounce and for it really to knock down the price of gold. That doesn't happen is probably because central banks are the whales in this market right now, and they're not price sensitive. They are tonnage sensitive. They've been ordered to accumulate X tons of gold, and so they're buying it regularly without worrying about the price, because that's not the issue for them. So we're getting a consolidation here, but not a very big one. Not the kind of stomach churning correction that chases weak hands out of the market. So, as long as the central banks are steady, if not aggressive buyers, then that kind of puts a floor under gold, because you've got big people who have monetary printing presses who apparently need to accumulate a lot of gold. And then look over at the crypto guys, and you've got entities like Tether that are setting up gold-backed stable coins, and they have to buy a lot of gold and store it to back those stable coins. And Tether is now, in terms of the amount of gold that it owns, it's up in the central bank range there. It's comparable to brand name country central banks. And it's just one stablecoin company. There are probably several others that are thinking about jumping with both feet into the gold market, because that's a really logical kind of stablecoin product there. So you've got a lot of really non-price sensitive buyers in the gold market right now. And that doesn't mean gold goes straight up from here, but it means that the wind is at the back of that metal's price. And that explains why we're not seeing the volatility that you would normally see in this wild bull market like we've otherwise seen for gold. So I don't know what to draw from that other than the gold thesis is still intact. We still might see some corrections out there, but it feels like there's a repricing going on. There's kind of a monetary reset going on in the world right now, and it's unofficial. But a lot of fiat currencies are being swapped for gold, obviously, with central bank buying like this. And there's a goal in mind for that at some point. The end game somewhere out there is for a lot of central banks to be able to back their currencies with gold. And we'll have to see how many of them actually do something like that in an explicit way. But I think that's part of the story going forward for gold and for silver, that there's a monetary repricing happening, and we're going back to the old kinds of money that can't be inflated away. And that's a very good thing for gold and silver one way or another.
You may have seen this headline recently. The U.S. just expanded its critical minerals list to 60 strategic resources, adding copper, silver, and uranium. Depending on the outlet, this move is framed as anything from quote unquote strengthening national security to quote unquote escalating a resource war with China. Same event, totally different narratives. This is exactly why I rely on ground news. It's a platform that lets you compare coverage across the political spectrum so you can see how each side is framing the same story. So when I open this minerals update on ground news, I can instantly see that over 70 sources have reported on this story. Scrolling down, we can compare the headlines. Some sources focus on economic resilience, others warn about geopolitical escalation. Taking a look at the bias distribution, we can see a pretty even split between right, center, and left-leaning sources. But my favorite feature is the blind spot feature. It shows you which stories are being underrepresented by each side, and political audiences aren't seeing the story at all. That alone says a lot. I like ground news because it doesn't tell you what to think, it just shows you the full picture so you can decide for yourself. Now, if you want a better way to stay informed, you can get 40% off the Vantage plan by using my link, ground.news/COSM, or by clicking on the link in the description box down below. It comes out to around $5 a month. John, do you remember I'm sure you remember, but remember last week, the day after Thanksgiving, when they pulled the plug on the CME?
Yes. Yeah.
What's your take on that? I mean, what's going on there? Is there some sort of cover up at play there? Are they unable to get delivery of some gold or silver? And I've heard silver may have been the root cause of this. What's your view on what transpired?
Well, I wasn't in the room where the cooling unit lives, but the coincidence is pretty extreme. I mean, when you got silver making a historic move, literally something that it's never done before in nominal terms. Mm-hmm. And that's the moment that the exchange goes down. I'm not a technician. I wasn't there. Here. I don't know anything, but yeah.
Right there. That's Friday is that big green bar. We're just shot all the way up.
Yeah. So exchanges tend to do things to limit volatility in the commodities that trade on the exchanges. They'll change margin requirements in a way that makes it less attractive to hold futures contracts, things like that. And so it could be that this is in the same category as that. But it was something that happened on the spur of the moment, and it was kind of an emergency thing. It was something that was derived more from panic than from any kind of policy. But I don't know. And the fact that silver wasn't really fazed by it, although silver's down today, so maybe we've got a delayed reaction happening today. But at the time, silver wasn't phased. A lot of people didn't pull out, and volume didn't crash, and silver didn't go back down another couple bucks an ounce. It just held on to an all-time high. That's a good sign. That means that people are interpreting the commodities exchanges playing games as a sign of weakness rather than a sign of strength. And which they should. I mean, that when commodity exchanges do things to stop trading, that means they're worried about what's happening if they don't stop trading. And that is a very big sign of weakness. That means they don't have the metal on hand to make good on all the claims on that metal that are now trading on their exchanges. So I mean, and that's the case. It's kind of a fractional reserve banking system in the metals markets, especially silver, where there are claims that dwarf the amount of physical metal that's available for delivery. And so you can't have all those claims stand for delivery because the metal's not there. So they're doing things to prevent that. And I suspect at some point they fail because the industrial demand for silver is so high and rising, and the supply of silver coming out of the world's mines is inadequate for the industrial demand. And then you've got monetary demand happening at the same time. As gold goes up, silver gets pulled up via the gold-silver ratio, and there's just not enough silver to satisfy all the potential claims out there. So I think everybody's watching this with interest because everybody in this market can see the math, and the math is very unfavorable for the exchanges and great for silver. So seeing that, if you're if you're General Dynamics and you need silver for missiles, you're going to go out and get as much silver as you need for the next few years projected demand, right? Because you're not going to stop supplying missiles to the Pentagon or to any of 50 other countries that are buying from you just because you couldn't get enough silver or the price of silver was too high or something like that. You're going to satisfy your customers whatever you have to do to get the ingredients for the systems that you need to put in your missiles. So spread that across the entire industrial economy, and you have a lot of stockpiling going on, maybe. Once again, in the face of a big deficit and shrinking above ground supplies. So we're getting close to the point of some kind of a squeeze in this market where, somebody takes a huge amount off the market. That causes some turmoil at the exchanges. That causes everybody else who's in the same boat as that first big buyer to panic buy, and then silver goes to who knows where. As the saying that's going around now goes, it becomes unobtainium. You can't get it at any price, and there are some people who just have to have it. So it'll be interesting to see what all this elasticity stuff does to the market when we find out that the supply is inelastic and no price is going to get you what you need. So we'll see. I mean, there's a good chance that something like that happens. We don't know when it happens. We don't know what the sequence of events will be, but we're creating the conditions in which there's a massive short squeeze in silver, and you basically want to be there for that, right? You want to have your stack created and stored in the right place, because that becomes a life-changing event for you if you're heavily invested in physical precious metals, as everybody should be who's listening to this.
John, I'm going to put you on the spot here, and I'm going to ask you. You know what? I'm going to ask this to every guest from here on out, up until the end of December. But this is probably the last time you and I talk for the rest of the calendar year. So give me what are like 2 or 3 big predictions that you have. I mean, just wild guesses, predictions, whatever you want to call them, for 2026. We're closing out the year, but I want to get your thoughts on what you see could potentially be a big happening in 2026.
Well, I think the silver thing is a potentially big thing that some people might call a black swan, but it just looks like the math working out. So we get a squeeze in silver. Another thing that might come along with that is something similar in copper, because that market is pretty tight. The yen carry trade, which we've already talked about blowing up, is a potential. Again, it's a black swan to anybody who's not paying attention, but it's a very big possibility as a crisis out there. And the biggest thing of all, though, might be the Fed easing aggressively, which it's already getting ready to do. Trump is getting ready to replace Jerome Powell as the chairman of the Fed with one of his guys, some of whom have been explicitly talking about a big drop in the dollar's value and much lower U.S. interest rates. So let's say we have the Fed do that, but the bond markets don't play along. In other words, the Fed cuts interest rates, but long-term rates go up because the bond market is not buying this story anymore.
That happened last
And
year.
then that means that's right. On a relatively small scale, though, rates went down at first when the Fed started cutting, and then the 10-year yield went back up to kind of where it was before. But it could be bigger this time, where it spikes to some unmanageable number. And then you got everybody looking at the government's interest expense, which is now $2 trillion, and that dwarfs the military budget by 50%. That kind of thing. When you see that kind of math on CNBC and CNN, then people get seriously spooked, and nobody wants to own the bonds of a country that is running those kinds of numbers. So something like that is conceivable in 2026. And if that happens, then that means we're kind of at the end of the fiat currency experiment. So this is potentially very big for economic history. We tried this experiment starting in 1971, where we trust governments to effectively and honestly manage our currencies. And they basically screw it up on an epic scale. And so over the next 50 years, we become more and more deeply indebted. The 95% who aren't super rich become debt slaves to the 5%. And we end up with civil unrest on the streets and in the financial markets on a scale that we've never seen before. So anyhow, that could all happen. I'm not saying it does, but it's a very plausible scenario. And then you get, of course, the monetary reset. So we're unless we keel over with heart attacks in the next couple of years, we are going to live through that part of monetary and financial history, which is fascinating on the one hand and absolutely terrifying on the other hand.
You mentioned copper prices moving up. Copper is often tied to the health of the economy. If the economy is in such dire shape, I mean, that's what a lot of people have concluded. I mean, I don't know if you would agree or not, but I think you may. But if the economy sits in dire shape and copper is going up the way it is, it appears that we're getting mixed signals here. What's the rationale behind copper's recent move up if you're seeing all these other signals of a weakening economy?
Well, yeah, you're right that it feels recessionary in a lot of ways. You look at student loan payments that are, those defaults are spiking in that market, and credit card debt is spiking, and the average interest rate on credit cards is through the roof. So you got all those people carrying balances that are quickly going bankrupt. And it goes on and on. A lot of different sectors in the economy look like we're already in a recession. But meanwhile, you got the government running massive deficits, and you've got the electrical grid being built out as kind of a national interest issue now. It's sort of kind of a wartime footing, where we've got to spend trillions of dollars on building out these. Oh, wait, I have to go back for a sec. One other possible big thing in the next couple of years is the AI bubble bursting. And because it turns out that we don't need all the AIs that are being built, and they can't do a lot of things that we expect them to do in any event. And because of that, a lot of the AI companies are not worth anything like what they're now valued at. And then that pulls the stock market down, yada, yada. That's a possibility too. But we're not going to let that happen without a fight. We've still got to build a lot of new nuclear plants and a lot of new gas-fired power plants, and probably lay down a lot of new solar panels. And then we've got to wire everything up to get that power from wherever it's created to wherever it has to be used. You need a lot of copper for that. So it could be that the economy is, let's say, lackluster in 2026. But the demand for copper continues to rise because we've got this once in a generation power grid build out happening that the government will finance if it has to. And so, that's the copper goes parabolic story. and we'll have to see. But I think that, yes, you've got a lot of risk in the copper market that you may not have in gold and silver, because the monetary reset thing is so imminent for them. But I still think copper is a thing to own, because so many of the plans we're making right now, and that we're not willing to give up, depend on electrification, and copper is crucial for that. So it's it's the definition of a critical metal, and I think that's good for demand for it and potentially good for its price.
Definitely. Well, John, I mean, I think we've covered pretty much everything I had in store for us. Anything else that you'd like to talk about that we didn't get into before we wrap this thing up?
Well, yeah, I mean, I think there's a decent chance of a serious equities bear market out there as all this stuff comes into play. We're we're at one of those tech bubble points where a handful of companies are elevating the other 495 of the S&P 500, and you take those 5 or 7 companies away, and you get a revaluation in the equity market. And so because of that, I think there's a big short thesis out there that, depending on how risk tolerant you are and how sophisticated you are, then it might be time to start taking a look at that. Like what would be a good short with, say, long dated put options in this market? What, because when something like that happens, for instance, in 2008, 2009, long dated put options on the banks and the home builders were 10 baggers. You made a fortune when that sector of the market collapsed. And I think we're back there again in a lot of ways. So, it's possible that put options are something you should have as an insurance policy, first of all, with your other equities. If you've got a lot of gold and silver miners, then maybe you want to hedge them a little bit with NASDAQ puts. And not a guarantee that works out that way, but if it does work out, if we do have a stock market crash and you've got some well-chosen puts, then you're partially protected from that. So it's just one more thing to consider in a market that's extremely precarious.
It's interesting you mentioned that. My good friend Chris McIntosh, who I recently interviewed, a week ago, he said pretty much the same thing. That's what he's doing. It's not like he's trying to get a 10 bagger out of this thing or anything. It's mainly an insurance policy for how the current market dynamics are. So it's interesting that you mentioned the same thing as well. Well, John, I appreciate your time, my friend. Where can people find you if they want to see more of your work?
Thanks, Danny. I'm at rubino.substack.com, and the newsletter I publish there is basically aimed at actionable advice for all the stuff we just talked about.
All right. We will have the link to your Substack in the description box down below. So be sure to become a subscriber, guys, and check it out. And if you got value out of this content, drop us a like and comment, "Go, John, go," in the comment section. And subscribe to the channel so you don't miss an episode. And by liking, subscribing, commenting, doing all the YouTube stuff, you do help in pushing us in the algorithm. So it may not seem like much, but a little bit certainly goes a long way. And if you'd like to take your support further, consider joining my Substack as a paid member. It's $8 a month, $80 a year, but your membership does help in supporting the channel. And you get access to all of my shows early and ad-free and uncensored for the videos that warrant it. So with all that said, I appreciate your time, guys, and I will catch you later. Bye.